using institutional futures to find a new trade idea. Perfect,
Yeah.
Mike. Looks great.
Speaking of which, thanks for thanks for filling that void there. I'm looking here now, Pete, at two very traditional. These would be normal products, I think, for most experienced futures traders. We have ZN plotted here with his, which is 10-year Treasury notes, pretty ubiquitous, very actively traded futures contract offered by CME here in Chicago. And then I have the ES, which is the S&P 500 future. So if you've been around the block, you definitely are familiar with these symbols. And what I've done here is just plot both of them side by each. And what I want to demonstrate is why and how we can trade these two different markets. And the thing I want to point out is look at the S&P from 2004 to present day. It's basically a straight line up and to the right. Now contrast that with Treasury note prices, which, yes, they are higher from their start in 2004, but they also show some unique behavior that is specific to, I think specific to interest rates, but also kind of extends to volatility products and some other commodity classes. And that is that it almost moves around this gray line here, this mean that I've plotted over the last 17 years. And this is, I think, Pete, I would love to hear your take on why rates kind of do this and how that presents an opportunity where they almost revert to this mean on a medium to longer term trend. Why is that?
They do. I think, it's funny. We all do look at that equity market. And if you look at it as if you're a contrarian, that was it continues to be an incredibly tough trade. The takeaway for me, first of all, on notes is that look at the amount of back and forth. That's what we want, is back and forth. Ideally, we'd love back and forth within a range and mean reversion. I think and I think we sometimes get the order wrong. And what I mean by that is, sure, we all focus on the equities markets, but the cost of money, which is the reflection of what Treasury notes are, what it costs to borrow at a risk-free rate for 10 years. The cost of money is really, in the long run, the engine that drives everything. It drives all business decisions in terms of spending, investment, expansion. What can I do it for? And that big piece is the cost of money. So there's an ebb and flow, a back and forth in terms of the need for credit and the, the lack of interest in borrowing. Part of the issue here too, and I think this is what lends to mean reversion, is you've got a non-price sensitive buyer in the marketplace. What I mean is the Federal Reserve buys $80 billion of Treasury debt every month. That's very odd. You rarely have one dude who's willing to come in, buy a huge chunk of the market, and doesn't frankly care what price he pays. So when you get that, you get this ebb and flow, and an outlier participant like that, whether it be a central bank intervening in currency markets, or in this case, interest rate markets, you tend to see a market that does mean revert. So in this particular instance, it's that non-price sensitive buyer actually causes a market to mean revert more likely than it would otherwise. So the tradable opportunity here, when you take a step back, the back and forth of being able to trade the range is much more enticing in these interest rate futures than these equity futures. That was a very long-winded answer to your question. Why do they mean revert? There you go.
Thank you for setting that context, though. And you're absolutely
a little bit too much.
Rates serve as the backbone behind the U.S. economy and global economy. So you do have this ebb and flow and this oscillation where we see prices of 115 up to 135, back down to 115 again. And that creates a really neat opportunity. And here it's in the long term, but I'm going to go to the next slide where we're looking at a much shorter period and moving from an outright to an actual spread. The reason this works so well is that rates are, in general, highly correlated. When the Fed engages in interest rate activity, those open market operations that you speak to, they're moving the short end of the curve. We're seeing it today, huge rise in 2-year interest rates, huge rise in 10-year interest rates. And oftentimes that's going to extend out and move the long end of the curve as well, some of those 30-year interest rates like we have here. Now, what that means is because they're highly correlated, there's a really neat spread between them. And not only are the outrights, those 2 10s and 30s on their own kind of showing mean reversion behavior, but the differences between the two is also presenting really cool mean reversion behavior. And I plotted here one of the more popular interest rate spreads, the knob spread, which is 30 years minus 10 years. Now, these are the prices. These are the Treasury future prices. So you would flip it for the actual year yields. But you can see that these do follow a nice oscillation pattern of up and down, but also staying within a spread of around 30 ticks. That tends to be the average we've seen between 30 years and 10 years over this period, which really, for a mean reversion trader, this is exactly what you want to see between two products. Is that right?
Absolutely. So, when you look at pairs, you want to see correlation. That speaks to the pairs. So what are we trading? The exact same interest, risk-free U.S. debt, single variable difference. What's the variable? The time, the duration of that debt. 30-year debt versus 10-year debt. So, as you said, by definition, there's going to be a strong correlation there. I love pairs trades between 80 and 90%. They're close, but they're not perfect. We don't trade 99.9% correlations. That's what an arbitrageur does. But here we have strong correlation, but price action back and forth. That is the key to any pairs trade. You can pick two random things that are at an extreme. You could pick crude and corn, and they're at an extreme, but there's no correlation there. So I'm really trading two independent occurrences and not being able to put them together. So we know there's a relationship here that's very strong. We know what we're doing is basically trading duration in this spread. So a single variable, which actually helps with reversion in a pairs trade. The challenge for me here, and it's everyone's challenge, is what does this different mean? You're bringing them up in a very clean way, and this is smart. You're just taking them 1-to-1 and just subtracting the price of a bond, which is around 159.5, and a note, which is 131, and that's where we're seeing that difference right now. The trade, though, is a whole different animal. And Mikey, walk us through this, because I know your eyes probably got really narrow, like everybody, like I did when I was started to learn these. I was like, wait a minute, I'm not supposed to trade them 1-to-1, and get the look from the treasury traders on the desk, like, oh my God, you're an idiot. So,
well, it's an unbelievable thing, because you would think, oh wow, this should be a very clean trade. It's one of the most common interest rate pairs trades. Interest rates are one of the most ubiquitous asset classes. There's got to be a clean way to trade this. And a great frustration that myself and I think many others have had is that this was so inaccessible. You can't trade it 1-for-1. You're not going to be properly hedged because these are quoted in price. There's a whole slew of variables affecting your ratio. You actually have to reference a website just to check to make sure you're properly hedged. And I don't even want to go through the trouble of trying to explain it, because quite frankly, I need a handout to reference what the tick values are again and what the proper ratios are. But there is now a very clean way to gain this exposure finally with the new interest rate products from the small exchange designed for the retail customer. You can trade this relationship on a 1-to-1 basis. And that's possible because those futures are quoted in yield now. So I've done the same thing. This is basically the same exact plot of the previous slide, except it's quoted in yield and not price. A little different time frame as well. But again, we're looking at the difference between 30-year and 10-year yields. And man, this is at what I would call a pretty fair extreme. Now, Pete, for people who aren't following interest rates and haven't been following the rate market, maybe because stocks have been more interesting or crypto is more interesting, can you set a little context here on what's going on with the yield curve and why we're seeing a spread of 500? I guess like this is a pretty relative extreme, I'd say, right?
Absolutely. And Mike, you went back here to December of 2020. You can yank that back to 2012, and you're not going to see this extreme in the difference in. So basically, what this is showing you is what does the market demand to loan you money for an extra 20 years? That's all this is representing. You could talk about it. It's a treasury risk-free. Don't worry about it. It's just, what do I want for the guarantee that I'm willing to give you money for an extra 20 years? And what this is, we talk about complacency. This is complacency. This is the market saying that they don't see any real long-lasting effects of inflation or anything else on the horizon that would almost, as we are at 50 basis points of difference, it's really indifference. I'll loan you money for 30 years for almost the same amount as I'll loan it to you for 10 years. Who wouldn't borrow the 30 years? Why does it stay that low? Partially because of the Treasury, the Federal Reserve intervening in that market. But this really, we talk about a low VIX. We also talk about pot odds. And this is one of those pot odd trades. Have we ever seen the yield curve go inverted? Which means 30-year yields would actually be less than 10s. And this value would continue to go and trade below zero. Now, we have seen inversion in like 2s and 10s before. It's very rare, and that tends to revert. The Federal Reserve and every participant has voiced a very strong opinion. They don't want anything to trade below the zero bound. And basically, they've learned from countries like Switzerland that has their 30-year, I think it's still, they only have a 20-year bond. It's 2%, negative 2%. So basically, if you put money in the bank, they take 2% of it away from you every year. It's insane. But it is what it is. But what they've learned is all those negative rate experiments have not yielded what they want, which is growth and inflation. So in my mind, the pot odds trade here at 50 basis points, complacency. We like that in the extreme. It means the market is kind of capitulated. And that's what we're seeing here is capitulation down to 50 basis points. The question to me is, so you understand this very, very simply. In these terms, if a 10-year treasury is trading at 150 basis points, we know the 30-year without doing any complex math. We add the 50 to it, it's trading at 2%. So that extreme, multi-year extreme, without it, and it can straddle the zero bound, but we're taking for granted that the central bank will actively prevent it from doing that. So pot odds wise, what we're looking at is a trade that is very, very interesting and very complacent. And the question is, how do we act on it, Mike?
Yeah, it's never been easier. I mean, the way it would just it's so nice. Finally, we can get exposure to interest rates. It's taken far too long. But now that the opportunities are here, it's very clean. Let me see if I can go to a platform here, and we'll show you guys here we got Tastyworks over here. I'm going to scale this screen. Just give me 1 second. As mentioned on the slide here, you can put on this pairs trade in Tastyworks for around $700 in buying power, which is just unheard of in the future space. So anyway, I'm looking at S30Y futures here. I'm going to go into the pairs trading tool. And here we're looking at S30Y. This is the November contract that X expirations we talked about at the beginning of the show. It is indeed expiration. And this S10Y, this is 10-year interest rate future. And we are talking about buying 30-year interest rates and selling 10-year interest rates. Now, something that was always a little bit of a struggle for me is if you're looking at a chart like this, and I'm back to the slides here, you see this price extreme on the low end. I always had the question of like, which am I buying and which am I actually selling here?
Right.
It's not that bad. The tip that Frank gave me and that I always kind of refer to is that this front leg here, we're looking at 30 minus 10 is going to be the leg that you're buying. So we're switching back to the Tastyworks platform. Apologies, I'm kind of jumping around here. But there we are. That 30-year interest rate is what we're buying, one, and we're selling one of the S10Y, that 10-year interest rate, basically going long that spread, hoping that the difference between the two widens out again. So that's basically as straightforward as it gets. Here we're getting a little better price than we would have gotten if we jumped in here yesterday, again, on the back of that 2-year and 10-year rally. But that's as straightforward and easy as it gets. Anything you want to add to that trade?
No, Mike. And what's great too is, when you bring up that pairs trade, and let's stay where we are, that's 48 basis points. So there's your extreme, and you're right. It's a little bit richer than we are, a little bit of a greater extreme. We're going out the week really at a tremendous extreme here. So this becomes a very interesting strategic trade. If you were to craft this in the institutional world of futures, it would cost you around $7,000 at a minimum. So here we're putting on the same trade. We can actually track it because they're both dollar ticks in a very simple and straightforward fashion. So when you go through all these extreme, yes, crude's above $80, interesting extreme. gold is of no interest whatsoever. But when you dive in a little bit deeper here, you look at, well, yields are low. They've recovered a little bit, but this still sits at the extreme. We like to find extremes, and this is it. So it was a wonderful walkthrough, Mike. You made the trade very simple, very clean, and it really is. If you really think about that, cost of money is the engine that drives everything. Why wouldn't you trade the front line of the marketplace? And what I mean by that is, why wouldn't you trade the first mover, not the tangential third mover from a movement in this money engine, but trade the front lines? And now it's manageable with small exchange products.
Exactly. You nailed it there on the outro, Pete. Real quick, one final thing I want to plug here is spread trading goes so much further beyond just interest rates. This is a screenshot from the weekly small exchange newsletter that community members receive every Monday morning. Here are just 3 additional spread trading ideas that came across our dashboard over the last week or so. You're looking at spreads in the new cryptocurrency equity index futures from smalls versus micro Bitcoin. That's an interesting extreme as well. You have things like equity index pairs trades, technology stocks versus small stocks 75. When you open your eyes to spread trading in general, just the opportunities really come abound. There's so many different ways to view markets through that lens. So thank you so much, Pete, for joining us on this show today. Hopefully you guys learned a little bit about interest rate trading. Apologies for my bad driving. First time doing this one in a while, but thanks again. And you got Splash into Futures coming up next and more trade ideas from Pete Molnat. Thanks so much, everybody.